Warren Buffett just sold over $4 billion in Apple shares. He also sold 41% of his stake in Bank of America, a position worth over $1 billion, and completely liquidated his billion-dollar stake in T-Mobile and halved his position in Charter Communications. This marks the 11th straight quarter that Buffett has been a net seller of stocks. The last time he was a net buyer was Q3 2022, and these massive sales have built up a record-breaking $344 billion cash pile, the largest in Berkshire Hathaway's last 30 years of data. When the world's most legendary investor stops investing and hoards cash on the sidelines, it raises some red flags. That is more than the cash reserves of Apple, Microsoft, and Nvidia combined. These are the world's 3 largest companies. Taking into consideration that Berkshire Hathaway's main function is investing and allocating capital to public companies, could this be a sign that Buffett knows something about the future of the economy that others don't? Buffett is known as the Oracle of Omaha because of how closely watched his investment decisions are by investors around the world. We're going to analyze in this video whether there's any truth to this, and try to understand exactly what his record cash allocation says about his outlook on the economy and financial markets. This isn't the first time Buffett has kept a big pile of cash out of the stock market. He also accrued a large cash position in 2007, the year before the global financial crisis, when the US stock market dropped by 60% during the worst recession in living memory. Buffett then bought the dip, deploying his cash reserves into new investments when stocks were trading at a discount in 2009 and 2010. His uncanny timing really makes it seem like Buffett knew something that others didn't. Again, in late 2021, Buffett's cash allocation was at a record high right before the stock market topped and began a 20% decline leading into the 2022 bear market. And yet again, Buffett used this opportunity to deploy his cash reserves into new investments. Now, Warren Buffett has never pretended that he was able to time markets. He said before multiple times that he never made an investment decision based on an economic prediction. So why the caution? Well, according to analysts, there are 3 main reasons why Buffett is building up cash reserves. The first is that he doesn't see any attractive investment opportunities in today's stock market. Indeed, one of his favorite valuation indicators is currently at the highest level since 1947. This is an indicator commonly known as the Buffett indicator, because Warren Buffett has previously said that this is a simple way to gauge how expensive the stock market is. This is the ratio between the market cap of the entire stock market and US GDP. Right now, it stands at well over 200%, meaning the S&P 500 is valued at more than double the entire American economy. Much of this extreme valuation comes from the frenzy around artificial intelligence, and even OpenAI's CEO Sam Altman has publicly called the current AI market a bubble. This might explain why Buffett is taking profits on a high performer like Apple. When valuations get this stretched, it becomes nearly impossible for a value investor like him to find great companies at fair prices, and historically, periods of extreme valuation have often been followed by sharp market corrections. The stock market is also facing an historic level of concentration risk. The 10 largest companies in the S&P 500 account for more than 30% of its market cap. This narrow leadership makes the market fragile. Buffett's second major concern is the soaring US government debt and the risk it poses to the dollar. The numbers are staggering. US national debt now exceeds the country's entire gross domestic product, GDP. History shows that when countries get into this level of debt, printing money often becomes the only way out, leading to severe inflation. At the most recent Berkshire Hathaway shareholder meeting, Buffett was blunt, stating that runaway fiscal policy is what scares him most about the US economy. He warns that as the government continues to borrow and spend, it may be forced to simply print more money to cover its debts. This would inevitably devalue the currency and erode the purchasing power of every American. So how is Buffett positioning his portfolio for these risks? He's not only sitting on cash, he's selectively buying businesses that are built to withstand economic turmoil. He recently added several positions in companies like homebuilder D.R. Horton, billboard owner Lamar Advertising, and industrial giant Nucor. These companies have 3 things in common that Buffett might currently see as beneficial for hedges against inflation. First, they all own real, tangible assets like property, factories, and equipment that hold their value when currency weakens. Second is cash flow. They're cash-generating machines, providing stability and income even when the market is volatile. Lastly, they're good value, trading at price-to-earnings ratios far cheaper than the broader market averages, offering a margin of safety. Now, it's important to note that not everyone shares Buffett's level of concern. The Federal Reserve is actively working to keep inflation under control and has so far succeeded. Inflation is not reignited as feared and has hovered around 2.7%. Major investment banks are optimistic. They see the federal funds rate falling to between 3% and 3.25% by the end of next year, which would signal that inflation is cooling off. Ultimately, Buffett's strategy isn't about timing a market crash or runaway inflation. It's rooted in his lifelong philosophy of value investing. Buy wonderful businesses at a fair price. When he can't find deals that meet his criteria, he simply waits, letting the cash build up. At Capital.com, we'll keep you posted on big moves by major investors like Warren Buffett, Michael Burry, Bill Ackman, and others. Hit like and subscribe to stay tuned. Thanks for watching.